What we're going to talk about today, though, briefly, is an introduction to Forex with very specific coverage today on what you need to know before you start trading Forex. So first of all, Forex, or foreign exchange, is the exchange of one currency for another, but it's designed around the relationship between one currency and another. So you may own US dollars, or you may own shillings or kwacha or whatever. But it has a relationship to the market there, but the influence of what you pay for something is largely directed by what the value of that currency is with the rest of the world. We do truly live in a global economy. So while you pay the same for a cup of coffee in Ethiopia 1 month, the next month the price may go up. The number of birr may go from 26 birr to 28 birr to 30 birr. And you wonder, why does the cost keep going up? Well, it may be because of the relationship of the birr to other dollars around the world. The cost of cups, the cost of machines, the cost of everything else is going up relative to the strength of the currency, which is largely related to the strength of the economy of that underlying issuer of that currency. So while you can write paper, you can create currency, the value of that currency is largely determinant for the price that you pay, but it's largely determined by the relationship from other currencies and other markets. So when we create debt, we typically, increasing debt decreases the value of currency, typically speaking. When everyone in the world, in the COVID example, is printing paper, then the question is, who's printed the most relative to the strength of their economy? And while you may have only added an additional 10% of currency into the population, if your economy was already weak, you may see your currency suffer more than someone that printed 20% of their GDP in new currency. So the underlying economy before it began and throughout those trying times is one of the greatest factors in determining what the outcomes are going to be like in the strength of that currency. So right now we're seeing a lot of relationship changes. Some of that is political, and some of that is directly related to the economic strength of the underlying countries that are issuing currency. So when we begin talking about foreign currency trading, it's important to understand that currencies have certain risks. And I just want to list a few of those today. So one of the risks that you have is the spread in the currency. And the less that a currency is traded amongst institutions and amongst countries with one another, the lower the volume of trading is, the wider the spread becomes. So in remote markets like Malawi, for example, when you go into Malawi, you can buy currency and there's a big discrepancy between what you pay because there's so much room to negotiate to buy the Malawian currency. When you leave Malawi, no one wants to buy the Malawian currency back from you. It's very likely you'll take a 15 or 20% hit because no one wants to buy the currency because it's steadily dropping day after day. Many of us have heard the stories about Zimbabwe, where Zimbabwe was literally going from issuing 1,000 to 10 to 100,000 to $1 million, even $100 million notes because their currency was dropping so rapidly. In the past few years, it's stabilized a bit. It's turned around largely because the largest banks in the country have begun to push for more stable action, and their economy has become a little more stable. But the currency can devastate a country. Oftentimes, the bigger trends in currency that are created by politics, that are created by spending of governments and issuing of more debt and issuing of more currency by those governments, have long-lasting impact. So while we look at short-term foreign currency transactions and trading, it's important to recognize that for the most part, currency trends are longer than we normally see. So when we try to do short-term trading in currencies, it makes it a little difficult because oftentimes the big impact or the big impetus, the pressure in the market is not short-term. So that leads to the second thing. One is understanding that spreads are wide in some currencies versus others. And so you need to be cognizant of that. And you need to trade understanding that if the spreads are wider, you need to trade for a longer period of time. The second thing that also suggests that you should trade for a longer period of time than strictly scalping in currencies is that those moves that happen in currencies that are created by institutions, institutional buyers and banks those folks are typically not getting into a single currency over the course of 30 minutes or an hour. They're building into a position, oftentimes at least for days and many times for weeks. So being able to pick out when those buy levels or those sell levels are can help you to make a lot more money if you're willing to sit in it. That being said, it's much better to trade small and trade longer when you're trading currencies. So that's the second thing to know about currencies. The third thing to know about currencies is that the preponderance of brokerage firms or FX dealers are not trading with you, but against you. So when you open an account with a foreign currency dealer, the smaller the minimum size that's required, the closer to 100% of basket trading is done. Some people call it basket trading. Some people call it a bucket, but they literally will say, we have accounts or we have direct feeds from X number of banks, 4, 6, 8, 12 banks. So they're pulling in data to show what the bid and the ask are with Deutsche, Dresdner, Credit Suisse, Bank of Japan, Bank of Australia, and others. But many of those firms have less than 10% of their trading volume actually goes to those institutional banks. They're bucketing your trade. So when you buy, they're selling to you. When you sell, they're buying from you. They're literally taking the opposite side of the transaction. Well, if you're confident in your trade, then it probably doesn't matter. If you're a newer trader, it's tough to get around the fact that they're actually trading against you. They are literally betting against you. It's like going in and betting on a game. And every time you bet on a game, the house is taking the other side. Well, that's actually kind of what gambling centers do. Casinos most often win. Casinos make tons of dollars. Well, the history of small accounts, so that you understand the risks of foreign currency trading, is twofold. One is that markets are volatile and they shake people out in the foreign currency markets. And as a result, people that are shorter term traders, on average, this is a study done by a group out of Ada, Michigan, a number of years ago, said that the average person opening a foreign currency account adds new money into their account 9 times in the first 2 years, 9 times. They're not adding money in because they're making so much. They're saying, wow, I'm doing so well, I'm going to put more money in my account and go from making $20,000 to $50,000 to $1 million. They're adding money in because they're losing. The numbers are very similar to people that are chronic gamblers. I don't want to say that if you trade foreign currency that you're a gambler, quite the opposite. There's tons and tons of money to be made trading Forex. Somebody's making money, right? But the challenge is you need to have the right approach. You need to be able to take wide stops. You need to have trade small. Instead of trying to make a huge amount quickly, make a huge amount slowly. So when you're trading foreign currency, remember that it's not like a traditional brokerage firm. Currencies are one of the few markets, unlike the stock market, even the bond market, and most futures markets, in that the firm can trade against you, one, on a regular basis. The brokerage firms can sell you the stock out of what they hold when you go to buy a stock. They can buy stock from you when you go to sell it. That's called making a market. They're able to do that. But one of the other things that's interesting and truly unique to the foreign currency market is that they can step in front of orders. What does this mean? This means that if you are the rich family, if you are the Soros family, if you are a large institutional family office or someone that moves markets, and you call a desk that I happen to work on and I'm a foreign currency dealer, and you say, look, I want to buy $200 million yen. I can turn around and call my buddy Bill up and say, hey, Bill, you want to sell $200 million yen? And he'll say, wow, you got a buyer? Yeah, I got a buyer for $200 million yen. Well, I don't really want to sell any right now, but let me check around and I'll get back with you. Well, Bill knows that I just translated for him that I have a huge order. He's going to step in front of that and go in his personal account and go buy $100,000 worth of dollar yen, because he knows this massive order, whether it's just today or over the next few days, is going to push the dollar yen up. I also call my other buddy and I say, Sue, you don't have anybody who wants to sell dollar yen. I got a lot to buy. Well, what do you think Sue's going to do? The same thing. She's going to go in her personal account and buy a bunch of dollar yen. In the meantime, that dollar yen is going to go just like this, bouncing up and down for the next several days until that volume gets done. Interestingly, the SEC did an investigation for people doing this in the stock market, and they came back and said, you know what, that's immoral, it's unethical, but it's not illegal. And so now there are professional trading desks that essentially buy and sell. They trade information in that same way with your equity orders. If you're a medium-sized institutional or family office or whatever trader. But in the currency world, not only can I share it with Joe and Bill and Mary and Sue, but I can step in front of it myself. So you call me to buy $200 million yen, I can go buy $1 million yen right now before I start filling your order. Again, it sounds immoral, it sounds unethical, but it happens all the time. So there are a few things to garner from that. One is that the brokerage firm is never your friend. They oftentimes, if they're not stepping in front of you, they're taking the other side of your trade. So you need to be confident that something is going from one place to another. So you either need to be riding a momentum trade or you need to be confident in the technical that you're using. So but use very clean technical analysis. You don't need to use super fancy things on foreign currency. In the foreign currency markets, you need to stick to 3 to 5 core patterns, and you need to rely on pressure. And pressure can go from one extreme and slide through and then fall and go the other extreme and keep going and going and going, which means you're going to be wrong a lot of times when something comes to the bottom, it's going to drop and drop and drop. And there really is no more institutional buying, but it just keeps on going. It's all the other people that are or sellers that keep coming in and coming in and coming in. And eventually they wear themselves out and it turns and goes the other way. The sweet spot for me in foreign currency, and this is just, I'm just sharing my personal information. The sweet spot for me has been 3 days to 3 weeks. And the reason for that is it's just on the outside of where institutions trade. Many of them are filling their orders within about 3 days. And some of them are working orders or building positions for several weeks, or a currency because of a political issue or because of something else. It's realigning its balance of trade. It's changing its policies and moving dollars to another country. It's converting dollars itself, a country on its own. Those things will cause that market to move for several weeks at a time. Typically 3 days to 3 weeks seems to be kind of the sweet spot. That's what I found on most of the majors. So you have 8 to 10 major currencies. We won't walk through all of them right now, but whether it's the euro backed or US dollar backed, or yen, Swiss franc, Aussie dollar, Kiwi, or the Canadian, it's any of the crosses between those major currencies have that kind of 3 day to 3 week sweet spot. So that means that you need to go back and look at the volatility on average for the dollar yen, for the dollar Swiss, for the Aussie dollar, whatever it is that you might be trading, and say, how much can this move? If it's going in the same direction for 3 weeks, how much variance does it have, even being right? If this drops, and I think now it's finished dropping, but it's going to go up, even if I'm right, when it goes up and down, if I'm wrong today and it drops to its max, what we would call the average true range, the ATR, in things that we normally look at for maybe 5-minute bars or 15-minute bars, but look at those on daily bars and say over the next several weeks, on hours or whatever the case may be, how much will this move out of sync while still staying in the bigger picture trend? And when you figure that out, you need to be able to take 1.5 times that risk and be comfortable with it, because otherwise you're going to get shaken out of trades. And you're going to find yourself losing $1,000 or $1,500 and only making 500 or 700 when you're right. It should be the other way around. You should lose 500, lose 500, lose 1,000, make 3,000. So if you do have more losing trades than winning trades, you don't have to be right even 50% of the time in trading Forex to make money. But what you do have to have is the proper allocation of risk. And that allocation of risk comes from recognizing what the pain is that you need to be able to take. And if you can't take that pain, then you need to trade something else. 1, you need to trade smaller. 2, or you need to find a different a different time frame that you can trade on that you're comfortable, right? And so the one thing that I really like about flow is that it's a pressure indicator, right? It lets you know where the general pressure is, and we see it across multiple time frames. And while many folks trade the 5-minute flow and day trade it and use it, because 5 minutes over 20 periods or whatever's 100 minutes, they can stay in a trade for a couple of hours, which really isn't scalping per se. It's almost swing trading, but it lasts for a few hours for that trade. Those of you who use the slingshot technology know that oftentimes we're in those trades for an hour, 2 hours, 4 hours, sometimes, as even today, some of those trades until the close, and we don't close out till the end of the day. But in foreign currency, I would say that the preponderance of time, you're going to draw your conclusions based on what you see on a 15-minute to a 60-minute chart. And a 15-minute chart, when we look out over the next time frames, we're generally looking at a period of about 40 bars. That's just kind of the average. Sometimes it's 20, sometimes it's 80, but somewhere around 40 bars. And so 40 15-minute periods is a long time, right? You're talking about 10 hours. So you're talking about a day and a half, 2 days, but you can also be talking about 40 hourly bars. So now you're talking about 5 days. And if you're at the beginning of something, you may end up in it for 7 or 8 days. And currencies do trade more hours than 24/7. So you'll find that when you begin, if you're trying to get in the sweet spot, you'll have more trades that are closer to 2 or 3 days than you will to 3 weeks. As you get comfortable with holding things longer periods, you'll notice that your average trade extends out a little longer. You'll also notice that your average win goes from being $500 or $700 to being $1,500 to $3,500 or $5,000. But you need to be comfortable with that, because you're going to see days where you're up $2,500 after 3 days of holding it. It finally went where it went. And then you're going to be inclined to take your profit. And the next day it's going to go back and you're only up 1,500 or up 1,000. You're going to go, gosh, I should have taken my profit. And then the next day it drops to a new low, right? It's setting lower highs and lower lows if you were short, and it made money, then it gapped back up. So one of the other things to do is to trade small enough. And this is $10,000 lots instead of $100,000 lots, for example, is trading small enough where you can either build into something if you're wrong, or you can average 2 to 3 contracts at a time, so that when you have a big move down, you get into the habit of taking profit off the table, and then letting the rest run or put a trailing stop on it. And then doing the same in the other side. You're going to have to quickly move to what we would call level 3. You need to get to the point where when you get into a trade, you sell it, you go, this is triple resistance, I'm selling it here. And then what's going to happen, it's going to go 2 more levels out, not 1. It's going to keep on going, and you're going to go, this is crazy. And what happens in Forex is they push people to the far end to cover all those people that were short. And you turn around and cover. And once they've cleared the book, then it falls apart. You've got to be able to stay in the saddle long enough that things stop and turn and go in the direction that you're wanting them to go. So foreign currency requires more patience. It requires more capacity for pain. And so one of the ways to do that is to be able to take pain that doesn't really matter. When something goes 1,000 points against you and you're only down $100, you can take the pain. But if you take 1,000 points against you and you got a full lot and you're down $10,000, then all of a sudden it hurts more, right? The philosopher Seneca had a saying, those who have everything to lose have a necessarily skewed view of risk. I deal with smallhold farmers in developing markets, and it used to astound me that these guys would not spend $50 to buy better seed and better fertilizer, or even fertilizer at all. And micro irrigation sets that cost $20. And the reasoning for me was that, 4 out of 5 times these guys are going to make 5 or 8 times their money. If they put in $50, they will easily make $250, $300 from the improvement in the outcomes. They will be more drought resistant. They'll grow 2 or 3 times more corn or soy or whatever the case may be. The extra water in the field will make them more money as well. But what you're asking them to do when you ask for them for $50 and they only make $1 to $2 a day, is you're asking them to go without a second meal a day for a month or two so that they can have that return 3 to 4 months later. It's like you and I being offered a lottery ticket and being told you have a 4 out of 5 chance of winning. How many places can you go that you get a 4 out of 5 chance of winning a lottery ticket, winning the lottery, and you win 8 times your money, even 5 times your money? Tickets are $10. Wow. $10 and I could make $50 or $80 off of that. Yeah, I'll take a ticket. In fact, I'll take a bunch of tickets, right? But what if I told you the ticket was $1 million? And if you don't have $1 million cash, I need you to decide right now, but if you don't have the $1 million, I'll take your pets as collateral. I'll take your home, your car, maybe even your children as collateral. Well, that's kind of what you're asking small farmers to do in Africa when you ask them to make that. But we step into that and we take that risk, sometimes not knowing, sometimes not really caring, but certainly not being cognizant of the fact that the numbers are inverse if you get stopped out all the time. And you get stopped out because you can't take the pain. So if all of a sudden you go, look, I have $1 million loss and I only had $1.1 million in my account and you're down 95%, most people can't take that, right? Many people let it go then because you're almost completely out of money anyway. But the point of it is you're now trading based on your P&L. You're trading on the pain that you're taking versus the technicals. And so pay attention to the technicals. Recognize that when you're trading Forex, it's very difficult to scalp. I know people that make money scalping Forex. I know many, many more times that number of people that make money scalping equities. I'm a strong proponent. I'll just share, I'm very frank with people. If you're going to be a scalper and you're going to trade 100, 200, 400 times a day, I would highly recommend that you trade in very liquid futures markets, or even easier, even better, trade in highly liquid equity markets. So that's one. If you're willing to take things overnight, and you're willing to sit on things for a longer period of time, or you live in Europe, you live in Southeast Asia or Australia, it makes sense to trade foreign currency markets. But scalping foreign currency is something I wouldn't recommend you start with. I would actually go the other way. I would actually start with swing trading FX and moving your way back, or swing trading CFDs and moving your way back into trading, into scalping, once you get where you have a pool coming from the larger dollars you make trading, swing trading, into taking smaller risks, making $100 or $500 or $1,000 a day scalping. So that's my advice on foreign currency. Those are some things that I thought were important for you to get to know. When you're working with brokerage firms and dealers, again, remember that if the minimum is $100 or $200 or $500, they're banking your trade. Very unlikely that they're sharing, that they're giving you the actual price or matching your trade. In fact, if you're trading small lots, I can guarantee you they're not sending that to Deutsche Bank, Dresdner, Bank of Japan. They're not on the other side of your trade. The firm is on the other side of your trade. And so that also means that they may be pushing the spread towards the side they want you to take. So if they're matching the bid or matching the ask with one of the banks, it's typically the side that they don't want. They're narrowing the spread on the side that they do want, or they're willing to take the other side of the trade. So one of the other things that I'd recommend is, as you set up account, it's probably not a bad idea to perhaps have an account with an institutional group, a larger FX firm, or even a second firm. Have one in the US and one in Europe, and just put in whatever it is, $500 or $1,000, so that you can see the disparity between the bid-ask spread. And you'll notice that the bid stays the same and the ask varies. Then the bid is probably a bank bid, and the ask is being manipulated by those firms. So it lets you know that when that's happening, the bid is probably stronger, and you want to be on the opposite side of the trade. So anyway, those are just some short things that I wanted to share with folks about starting in the field of foreign currency and FX trading. I would also encourage you that to pay attention to flow to the longer term periods, the 15, 30, and 60-minute periods if you're trading FX. We're also going to be launching the slingshot signals on FX in the coming week. So you should absolutely use those. If you're looking for it, I think you'll be astounded by the results that you get. And if you have any additional questions, please feel free to share them in the chat room or email me directly if you'd like. And I appreciate your being here, and I hope that this added some value. I'm going to stop the recording now and take questions from our members.